Hey everyone, welcome back to another stocks video, taking a look here at the daily performance of today's stock market, but we're also going to talk about this market as a whole. Is it cheap? Is it expensive? Should you be buying before we hit all-time highs? Let's jump into all of it. So starting out with the daily chart performance here of the S&P 500, it's a mostly boring mixed day. And what I mean by that is you can see we have a little bit of green, a little bit of red everywhere, but things get a little bit more interesting when we start looking at the 1 week chart, and even more interesting, keep an eye on the colors here on the 1 month chart. What you'll notice here is there's an uneven distribution of performance. Specifically, you can see some of our tech and pseudo tech or comm services doing quite well for the most part outside of the telecom services, and doing really well here on semiconductors like Nvidia, Broadcom, AMD's been killing it here recently, Microsoft, these are your software infrastructure names. You can see some uneven distribution, because what I mean by that is then we take a look at like financials, and they have not been doing so well in the last month. Insurance companies also not doing particularly well, and we've actually seen drug manufacturers doing well, but medical devices kind of lagging, which by the way, this is an area of the market that I like, so maybe we can take a closer look at that. And also worth noting is that our consumer cyclicals have been performing pretty poorly this year, specifically things like Tesla and Home Depot and Lowe's, Ross Stores, TJ Maxx, McDonald's, all these kind of optional spendings that people do have not actually been doing very well in this pretty uncertain time with all the tariff stuff that we've seen. And also worth noting is that even our consumer defensives, your Walmarts and Costco's, have had a little bit of a lag here in recent times. However, at the index level, you can see we've recaptured a lot of our moving averages here with almost everything lining up again, and we are near those previous all-time highs when taking a look at the SPY. Is this thing headed to new highs? And if so, what could get us there? Well, a quick look at the macro screener here on the stock box, and what you can see here is we have a pretty mixed view when it comes to stocks impact. Specifically, a lot of our inflation metrics are good for stocks, but then things are not so good when it comes to PMIs, which show, forward-looking indicators of the economy suggesting a little bit of weakness. So with a stock market that has rallied so much, the question is, are there still opportunities to be buying stocks after having such a massive run up? Just remember, most people were way too scared to buy stocks when the market was selling off a cliff, but now that things are back to the highs and we've rallied 25% from the lows, a lot of people are wanting to chase back in. But in this video, I'm going to talk about why this market, I think, could really use some pullbacks before we jump into a whole bunch of stocks, and I'll share with you some ones that I'm personally watching. That being said, the bigger picture in my view in the coming months and years, from a longer term perspective, I still think the stock market has plenty of upside, and when we take a look at the weekly chart, we're back to these highs, and I do think that we can continue to support growing earnings that should lead to the stock market being a strong place in the future, at least for now, right? I think that there's a lot of geopolitical headlines with what's happening in the Middle East, with Israel and Iran trading strikes on the 5th day of the conflict right now, but we're still seeing stocks continue to drift higher despite this. And with tomorrow's FOMC meeting, people are wondering whether or not the Fed will cut interest rates. Probably not this week, but in the coming meetings, how soon are we going to get rate cuts? And of course, if we do get rate cuts and we see them coming in soon, it is likely, in my view, that the stock market can continue to support higher multiples. And what I mean by that when I say multiples is the willingness for investors to pay more for the same companies, right? So when we talk about an environment where rate cuts are happening, people have a tendency to be more willing to buy more speculative growth particular stocks at higher costs or price versus earnings. But take, for example, a stock like Walmart, which is a very kind of boring, stable, steady Eddie business. I mean, boring depending on who you ask. I think it's a pretty cool business, but in terms of an investment perspective, it is a pretty boring business. It just kind of grows slowly and steadily over time. Although in recent years, the stock has done phenomenal. There was a period of time where I watched, Walmart go sideways for multiple years in 2020 and 2021 when everything was going crazy. But now businesses like Walmart are absolutely skyrocketing. The stock has done phenomenal over the last couple years. And so I look at this and I say, is there value here in a stock like Walmart? Well, here's the thing that concerns me. When we take a look at the PE ratio, and I've selected for Walmart, you can see while we do have steady rising overall revenues for a stock like Walmart, by the way, side note that I think is interesting, a company like Walmart operates at the net or profit margins of around 2.7%. So for every $100 that you spend, the company actually only makes around $2.71, which I think is really interesting. This is a high volume business, and there's not a lot of wiggle room for recessions in a 2% or 3% profit margin business. And so I wanted to kind of bring this into our attention. You can see the yellow line here is the stock price over time, which, as you just saw on the other chart, has been steadily rising over time. But the challenge here for me when it comes to stocks right now is that when we take a look at the price to earnings ratio, we're talking about a stock here that has a forward PE, which is, accounting for future projected earnings for this company, at almost 35. And when we take a look at the PE trailing 12 month, it's in the 40s. And so when I look at a stock like Walmart, is it an incredible company? Yes. Is it growing in terms of its revenues and incomes? Yes. But where I struggle on a stock like this is the valuation is just remarkably high on this as well as many other key companies. Take, for example, Microsoft, which is a remarkable business and one that I would love to own some shares in, but the challenge here again becomes valuation. Microsoft, while growing earnings and revenues very consistently, having a high margin business, this is a business that I would love to have in my portfolio, is still very richly priced. And this is the thing that a lot of times people who are newer to stocks struggle with is it's one thing to say, hey, Microsoft is a great business. It's another one to choose whether or not it's right to buy Microsoft at this time. Because if everybody already expects Microsoft to do absolutely remarkable from here, it is a little easier for investors to get disappointed. So personally, when I look at the stock market right now and I look around the options out there are still great companies that I think we can potentially pick up on deals. But for me personally, I do definitely want to see pullbacks in the market and for those earnings or the PE ratios across the board to relax a little bit before I can actually back up the truck and start buying stocks again. Now take a look at the Qs during the sell-off that we saw in April of 2025. This is an example of a time in which a lot of price to earnings ratios, a lot of kind of metrics that we value stocks based on really came in, right? So what I mean by that is they really relaxed a little bit. Now, of course, there was a reason that PE ratios came down. It was because people were concerned about what the Trump tariffs could bring. But what you'll find if you watch stocks and try to value them is that almost always a dramatic drop in PE ratios comes with a very scary headline. And so I take those opportunities as opportunities to specifically pick out stocks that I really think have the most potential longer term and buy those ones during all of the craziness. And a couple stocks that I personally bought down in the April sell-off here were names like Fortinet, which is a cybersecurity company, which I think has a lot of potential upside. Or companies like PayPal, which I haven't done remarkably well on PayPal, but this is a company that I quite like and actually think that if it continues to push lower and the market rolls over a little bit, I may take that as an opportunity to pick up more shares of PayPal in my portfolio. You can see PayPal has rising profit margins, overall steady growth in terms of their net income and revenue, and the PE ratio on this stock is much more modest and actually down significantly from how it used to be valued much higher. For example, take a look at an example of when it was around an $80 stock over here and the PE ratio was down in the 19s versus when it was a $79, $80 stock over here and it almost had a 40 PE. So this valuation on this company has really come down, and so that means that while the price of the stock has not changed too much in the last few years on a big picture, the earnings have grown into the stock price. And so I really like that scenario a lot better. So I like a stock like PayPal. Now that does not mean that I'm going all in on PayPal, but when it comes to a stock like PayPal, I think that the expectations for this stock are much more modest compared to something like a Costco or a Walmart or a Amazon or a Microsoft, these companies that have very, very high expectations. So as we look at a stock like PayPal, this is one that if we got a little bit of downside in the market, I would definitely be looking to pick up some shares in a stock like PayPal. And again, it doesn't mean I'm going all in on PayPal. I have many stocks in the portfolio, but it's one that I would add potentially to if we got a little bit of downside in the market. Another stock I've been looking to add more shares to is Uber. And again, what I'd like to see here, as we discussed on the higher level in terms of like the overall index, I'd like to see the S&P 500 pull back a little bit in order to kind of put everything on a little bit more of a discount. But stocks like Uber, stocks like Robinhood, stocks like PayPal are names, and Google for that matter is another one that I really like. These are stocks that I'd be looking to add in on on. And this is the beauty of stock picking, is what we can do is we can look at the index level, we can look at kind of like craziness causing the market to get spooked, and then we can go pick out the names that I think have a little bit more opportunity or a little bit better risk reward profiles. And at the end of the day, that is what it's all about when it comes to picking stocks, is you're trying to pick stuff that has a better risk reward ratio. And I saw some interesting news here this morning. The Trump organization is debuting a cell phone service called T1 Phone at just $47.45 a month. And of course, CNBC had to fire back, saying that Trump's $499 smartphone will likely be made in China. Of course, this is definitely in spite of the Trump team, because the Trump organization's newly announced T1 smartphone will be built in the United States amid US President Donald Trump's push for more stateside manufacturing. And we know this very well. This has been a drama point between Tim Cook and Donald Trump about having the iPhones created in the United States. Many people pushing back on that idea, saying that that would cause iPhones to come up to like $3,500 or something crazy like that if they were built stateside. Yet the phone will likely be produced by a Chinese original device manufacturer, one analyst said. And this is to note, right? So this is definitely not confirmed by the Trump team. So this is one analyst saying that. And just an example of how like a CNBC or any, network who doesn't like a particular left or right leaning candidate or president or whatever can kind of blow it out of proportion a little bit. The phone is advertised to have a 6.8 inch, I don't know what that says, display and 50 megapixel camera. So just thought this was an interesting little side note today. Of course, Apple's share price is not moving too much anyways. However, it's been in a pretty persistent downtrend. Perhaps part of the reason for that is the distaste that Trump has for this whole situation with iPhones not being made in the States, and the kind of seemingly unwillingness from Apple to do that. Again, it would cause the profit margins to either go down significantly on iPhones, or it would cause the cost of iPhones for the consumer to rapidly expand higher, both of which are options that Apple is not interested in doing, because of course, either you're going to make shareholders really upset and cause the stock to crash, or you would cause consumers to have to pay these insane prices, which would also probably cause the stock to crash, because the demand for iPhones at $3,500 is probably beyond a lot of people's budgets. I mean, that's a lot of money for an iPhone. And those things are already expensive as anything. Like, for example, the Apple iPhone 16 Pro Max, which I couldn't tell you one thing that's different about the iPhone 16 Pro Max from the iPhone 15. And it says it's typically, this is Google's Gemini, I assume, or whatever this software is, pretty cool. Typically around $1,480 to $1,899 for something similar. Speaking of Google, this is another company I really like and would like to add more shares to. I do have a good sized position, but would like to add more if we can drop down into the 160s again, especially if we get a little bit of downside movement in the stock market. I would take that as an opportunity to scoop up some shares of Google. Google's a stock that has a remarkable revenue and net incomes growth. They've got the growth, they've got the profit margins, and what I like about Google a lot is it's trading around a 19.5 forward PE, which is significantly lower than some of its peers. Take, for example, a Microsoft, right? Another giant company, kind of conglomerate, and you can see this is trading at 31.8. And so I like this company quite a bit. By the way, the tool that I'm using here is called the Stock Box, and if you'd like some information or a extra discount for watching my stocks channel here, then consider using the link and promo code in the description to get a copy of the tool for yourself. If you have any questions, you can also message in on our website. Just let them know you were watching my stocks YouTube channel, and we will give you some crazy extra discounts on the tool, because this channel is very small and I really greatly appreciate your support. If you message in and let us know you were watching, we'll give you further discounts. Just let us know that you were watching this video today. And again, thank you very much for supporting this new channel. I hope you subscribe and like the video if you like stocks as much as I do, and we'll see you in the next one.